Aditya sir, can we start?
Yes, sir.
Great. Good evening, everyone. Welcome to a practical approach to retirement planning. Amidst us, we have Mr. Suraj Kaeley, and he brings in a lot of experience for all of us here at Together Investing Club. And like we've all promised, all have been promised at the club that we'll keep inviting industry veterans and industry experts who would teach us on a very specific or a very niche domain. And here we have, Suraj sir himself. Has a wonderful track record, and the entire industry recognizes him for his Lawrence efforts. So I would like to invite Isha to go ahead and come on board and invite him and to tell us about his achievements and his success so far. Isha, over to you.
Thank you, Emmanuel. Good afternoon, everyone. We are all gathered here to understand how we can have a practical approach towards retirement planning. And it gives me immense pleasure to introduce you all to Mr. Suraj Kaeley, who is a mentor and a retirement specialist. He holds a prominent position in the Indian financial service sector from past 25 years. His journey has been a proud one. He has worked at top positions at Franklin Templeton, MetLife India, FIL Fund Management, L&T Financial Advisory, and the last being the group president of the UTI mutual funds. He is also been awarded the Investment Foundation Certificate badge by the CFA Institute. So, ladies and gentlemen, on behalf of everyone present here today, I would like Mr. Kaeley to take us through his journey once and enlighten us with his knowledge and expertise on retirement planning. Thank you.
Yeah, thanks, Isha. So thanks for those kind words. And so what I'm going to really do today is maybe take about 20-25 minutes to give you a little bit, insights on how you could, plan for your retirement in a very practical manner. And then we'll open up for questions, because I do believe that, most of the insights happen only when you ask questions. Otherwise, it's just a monologue that happens from one end. And I must share a very, startling statistic to begin with, that almost 70% of people, eventually feel whatever they have done for retirement is pretty inadequate. So there's a lot of research which shows that retirement is not something which is pleasant. And so personally, when I made this as a core part of my study and my future in a way, I came across some very interesting insights, and I felt that if I could put all that together in a cogent way, very easy to remember, easy to deal with, I think it would make a lot of sense. So typically, when you talk of retirement, I would say that the financial related issues are the least. Actually, there are other issues which are far more challenging. Mainly, how do you really spend your time? How do you keep yourself fit? How do you socially engage? You don't really get into a depression of kinds because you don't have now a great circle. So there are many different kind of challenges which comes, but in most cases, typically the planning for retirement starts with the financial stuff, right? So obviously it makes sense to start with financials and then deal with all the other issues. So the way I would really go about this stuff is that today when I look at retirement planning, let's assume that whether you do it consciously or subconsciously, everybody has some kind of a plan in their mind. Some of you may be fortunate if you're getting a pension. Some of you may have assets. Could be commercial property, could be residential property. You're getting rental income from it. And some of you may continue to work a little deep into your career. So especially if you're in the medical profession or law. So every individual has some kind of a plan, but when we say retirement planning, what we are trying to really say is that we bring it alive by really actually documenting our thoughts rather than leaving it in your subconscious mind. Because as you do that, you tend to get some more color about actually what the challenges are going to be. So what I would do is just take you through first a set of challenges which I believe are most important, and then look at a plan, and also then look at maybe how do you transition from where you are into that kind of a plan. So typically when you look at retirement, I would say there are three big challenges that you need to deal with. The first challenge, which I think many of them don't think it's a challenge, but in my view, it's a big challenge, is the inability of really trying to forecast our expenses in retirement. Now, think about it. If you're not very clear about your expenses, then how do you really go about, making any plans around it? So I will start with that as the first step. The second part is we tend to underestimate how long we live. So longevity is a very silent revolution going on. And so I will talk about longevity and its impact on retirement as well. So especially from a financial planning perspective. And the third part is, okay, how do you create an investment portfolio? So what are the challenges that happen when you try casting an investment portfolio around it? And once we have addressed these challenges, or we have, in a way, enumerated the challenges, we will look at a financial plan, which can be put in place to address these challenges. So let me start with the expenses. Now, expenses is actually a function of your lifestyle, right? So if you're not very clear about what kind of a lifestyle you want to lead on retirement, how do you really estimate your expenses? So most of us tend to take a certain percentage of our current expenses and try to project it into the future. But the reality is that the lifestyle that you're going to lead is fundamentally going to be very, very different. So for example, if you want to spend more time holidaying, right? So you have a lot more expenditure on leisure, which otherwise you may not have planned in your regular day-to-day life. Some of us may want to do a lot more charity, but again, charity needs some amount of financing. So if you really don't think about it, that's not going to really help you either. And the most important of all is that there is one expense which is totally an unknown, and which is your medical expenses. So you may budget everything right, but you just don't know how to deal with this problem of medical costs, because medical costs, can occur in two ways. One is if it is a routine kind of a age-related illness and you're just taking some basic, medicines and treatments, it may be a more of a recurring cost and may not be very substantial. But if you have to undergo some kind of a treatment like a knee replacement, a heart replacement, or something like that, it can be enormously, expensive. So, and there are some kind of diseases, especially like cancer, where the expenditure is not only large in the initial part of the treatment, but also can be extremely large later on. So obviously, many of you may have bought insurance and medical insurance and would say that, okay, I have something about it. But the reality is that that is a very unknown kind of an expenditure. So you need a plan which can even address some of those uncertainties. So in my view, a very practical way to plan for investments, especially in retirement, is to actually think through your lifestyle and do a bottoms up kind of a calculation. Don't take a hypothetical number and start saying that, okay, I think I'll need 1 lakh of monthly expenditure, so let me plan for 1 lakh. So when you start enumerating each of those items, you will realize that there are certain expenses which are a necessity. So just to give you very simple, examples, the house you live in, so house maintenance, would be a core expenditure. You would have insurance premiums as a core expenditure in retirement, your regular day-to-day living expenses as your core expenditure. And then there is a discretionary expenditure, right, which you believe that you want to, spend on things, but they may not be the most important. So, but if you have that as the second bucket, that can be helpful. And then a bucket which says that, okay, I should also budget for some medical emergencies. So my view is that from a practical standpoint, don't look at it as one single number. Put 3 different buckets and deal with them independently. So don't try to really address all the 3 together. So that's the first step I wanted to talk, which is related to expenses. The second major issue in retirement is longevity. And so obviously in a COVID world, and especially these online sessions, I can't make it very interactive right away, but normally I've asked this question to everybody, that how long do you think you should plan for retirement? So, and many times I ask them, so do you want to plan till age 110? And they all get started and tell me that why age 100 or 110? And then I give them some very simple statistics that children in the West born today have a life expectancy, or an average life expectancy of 105 years. So there is a silent, revolution of longevity going on. And so urban households in India, also are expected to live much longer. And that is because of the advancement in medical technology, that has happened over the years. And almost for every decade, we end up about 1.5 year of additional life expectancy, that gets added because of these medical advancements. And typically, you don't have to really look too far. You will find that your own parents, are living longer than your grandparents, and your grandparents lived much longer than their, parents. So obviously, when I look at ourselves, it's still, I would say that anywhere between 90 to 100 is the least that you have to think about. And now the challenge is that the amount of money required has a very direct correlation to the number of years that you will have in retirement. And hence, this age is very, very important to think about. So my advice generally has been that when you do a plan, the least you plan is till age 100. And because that's the most, practical way to do it, because you don't want to get surprised that, okay, I planned till 90 and now, I don't have anything. I have another 10 years to live. You don't want your last part of your life to be in trouble, right? So you want to be ensuring that you are in good shape as long as you are alive. So that I think is very, very important. So longevity is the second big issue. Now, from a financial planning standpoint, longevity brings associated risks of inflation. So in India today, for example, we have inflation of 4 to 6%. In fact, RBI has the mandate to keep inflation between this band of 4 to 6. But we don't know over the next 30, 40 years what kind of inflation rates we may actually experience. So one, it is not a fixed number every year that today it's 4%, next year it's 5. It really can be very, volatile. So there will be periods where inflation can be as high as 8 or 9. Sometimes the inflation may just hit you because the kind of expenditures that you do, they may be getting expensive, and the rest of the expenditures really don't matter. So for example, in today's day and age, the fastest growing expense is actually children's education. Now, if that is not a part of your expenses, then you're not really hurt in any manner. But if for any reason you have a specific expenditure, so even the broader CPI data will not capture that, but you will experience that you need more money because of inflation. So typically I advise that, we look at, in the least inflation rate that you should look for is about 4%. Now at 4%, what it does is that over a 40-year period, so let's assume from age 60 to age 100, you will lose, the money will lose almost 75% of its value. Right. So, which means that if you are planning to run your household expenditure with 1 lakh today, every month, then you will need about 4 lakhs. That's really the implication of it. So it is not only important to plan for what will happen in the next 3 to 5 years, but when you take a longer term view, inflation also has to be a part, and that has a direct correlation to longevity. In the past, this was never an issue because most people would, let's say, retire by 58. Life expectancy in India was close to about 65, 70. So you only have to plan for 10, 12 years. But I feel today's generation likes to retire a bit earlier. Even if you don't retire, you get, redundant from a job profile. So you are thrown out, and now you need to fend for yourself. And so most of us, if you're planning getting retired around 50, 55, and you have another 45 years to go, I think it can be fairly challenging. The third piece, apart from inflation, is then, of course, now you want to cast your portfolio. And again, you make certain assumptions. And normally in my conversations with individuals, I found that most of us tend to overestimate the kind of investment returns we'll make in the future. So if I ask somebody, how much do you think you'll make on debt? Most of the answers I get is somewhere 8 to 9%. Now, just to give you some numbers, if you today buy a 5-year fixed deposit from State Bank of India, you earn only about 5.3%. Right. So now imagine you're thinking that, okay, I think I'll make 8 and 9% in my fixed income investment. So I feel you tend to overestimate. Similarly, from the stock market, if I look at returns, we find that we estimate around 12 to 15%, but in reality, they may be closer to 9 or 10. So the last 10-year return of the Nifty, has been only about 7%. So obviously, if you overestimate, then of course, investment returns come much lower. It can be a big challenge. And the other part about investments is that, though we may take an assumed return, the reality is it's going to be very volatile year on year. So even if you put all your money in fixed income products, let's assume a bank FD, right? And I'm not even talking about tax efficiency and other things. But reality is that once the bank deposit matures, it will get repriced. And so we don't know whether you'll get a higher rate or a low rate. So when I started my career in the late 80s, India would have interest rates upwards of 15 to 18%. And I know of individuals who would tell me that if I retire today with a crore or 50 lakhs, I can make about 12%. And so it's a very attractive rate of return to have. But this may or may not really, pan out over your career, because retired life is a pretty long, period of 30 to 40 years. So it is not a short period of 5 to 10 years where you can take that risk. So the context I wanted to build was that these are the three big, challenges that you deal with: expenses, longevity, and the implied return of investments. And the way you then go about really starting to build a plan is that, okay, if I now want to address all these issues, so how should we go about it? And so I have evolved a very simple 4-step process to do that. And the first step is very simple, that even before you start your retirement planning, you must set aside money for any liabilities that you may have, or a major expenditure that you may have. So typically what I've experienced is that wedding expenses for children, that could be a major expenditure which is not completed. There could be some outstanding loans, so especially if you have taken a mortgage and not repaid it fully back. So ideally, a good situation is to start is to say that, okay, I've set aside money for all my liabilities, so that we know how much money is left out. The second thing which I then really go about in my plans is to look at the medical expenses. And why medical expenses? Because and then discover that maybe your medical policy did not cover that particular ailment. It can also happen that you bought a certain policy, and so typically these are yearly renewable policies, right? So medical insurance, if you don't renew on time, they insist that you now go through a medical test again before you get the policy again. God forbid you forget one time to make your payment on time, and suddenly you find that your medical cover is not practically there. So my view is that what you should really do is, in addition to your medical cover, set aside a sum of money. Could be 10 lakhs, 15 lakhs, 20 lakhs, whatever you believe you can set aside, and say that, okay, this money we shall only use in case of a medical emergency. So it is not really touched, or it does not have any other purpose. And typically you would invest in safer instruments, because you know that you want to utilize this money. Now the good part is that if actually you earn about 6 to 7%, you will realize that your medical cover which you have set aside yourself, will keep doubling every 6, 7 to 10 years, right? So, and that's where you will be sufficiently covered, even if your medical policy does not, help you completely. So obviously, most of the insurances will take care of these things, and there are cashless facilities, and there are many other things to deal with. But reality is that put aside some money which you can say that, okay, that's my medical fund. I will not use it for any other purpose. So that's the second part of your plan. The third plan is, now where should you make your investments? Because that's the big piece there. And essentially, from an investment perspective, there are two extremes where you can invest in. One, you can invest in risky assets like stock markets and equity mutual funds, or you can be in extremely safe products. So these can be government bonds, or this can be fixed deposits, this can be debt funds. And my personal view has been that getting to both extremes is really fraught with a lot of risk. So if you go down the path that all your money is in safe assets, then inflation becomes a big issue. If you put all your money in equities, then you're risking your principal completely, which I think is also not advisable. In fact, I have done some, number crunching on both sides of the spectrum, what happens. And I find that in both cases, if you're on extremes, you really struggle. So the key answer here is that, okay, what part of your money can you really withdraw to fund your expenditures? And my answer has been that the safest number is close to about 5% on a post-tax basis, not even 6, because interest rates have come down. And if you withdraw close to 6 and your portfolio is generating, let's say, about 7 or 7.5, you're leaving only 1.5% to address the inflation requirements. So my view is that you need to leave aside about 2 to 3% at least to adjust for inflation. You may not really cover the entire inflation rate of 4 to 6, because over a period of time, you will realize that as you age, your expenditures generally come down. So when I've really done, some research informally actually to figure out what was the dip in expenditure when somebody retired in the first decade to the next decade, almost in every case, I found depletion of almost about 30-35%. And the only exceptions were where there were medical expenditures which were fairly substantial. So my sense was that since we have planned medically separately, leaving about 1 to 2% higher into your portfolio is good enough to take care of your inflation requirements. You don't have to really budget for a very significant number there. Typically, my recommendation is a 70-30 ratio, where 70 is in fixed income and 30 is in equities, is probably a good starting point for your retirement plans. And then depending on your individual case, you can change this ratio to 60-40 or 80-20, depending on your comfort, but at least ensure that you're not zero in equities, right? You have some exposure to long-term assets. So that becomes the third part of your financial plan. The fourth part is about leaving a legacy, right? And so obviously we all want to leave some legacy for our next generation. And my view is that there are two approaches to take for it. One approach is you say that, okay, all my money that I'm now saving, I will not eat anything out of it, and I'll ensure that this money gets passed on to the next generation. But there's another alternative, and the other alternative is very simple, that if, just to give you a hypothetical number here, so if you were to save 10,000 rupees every month, so you say that, okay, whatever money you want to leave for the next generation is like an expense, and you're going to plan for it during your retirement days. A 10,000 rupees saved every month for 20 years at 12% grows to a crore, right? So if you're willing to put aside 40-50,000 rupees, you can actually create a 5 crore corpus over the next 20 years as well. So, but most important is you must treat it like an expenditure. So don't look at it like an investment, because when you treat like an expenditure, you will be willing to take a little bit of a higher risk in it. And anyway, you're going to leave it as a legacy. So to that extent, you can take a little bit of a higher risk in that part. So my sense is that creating legacy distinct from your other corpus will actually free you up substantially in terms of being able to even dip into your principal amount should you require. And that can make life really pleasurable in your retirement days, because you know that even if I eat out of my principal some amount, it doesn't hurt, because anyway I'm building a corpus separately, which will be available to me 20 years, 25 years down the line, because I'm putting some money aside as an expenditure. So investment also has to become like a necessary part of your expenditure bucket. So that's the way I really believe you can go about your retirement plans. One last point I will make is that wherever you are and you want to make a transition, this is where I think the biggest problem I see in retirement, that most of us, suddenly want to change our investment portfolios on the day of retirement. So I have met several individuals, and when I look at their portfolios, and they may have just 2-3 years to go by, they will be like 60-70% in equities, or in real assets, or in, more volatile assets, if I may say so, and only 20-30% in debt. And suddenly they believe that, okay, on the day of retirement, they should shift entirely. Now, as I mentioned to you, because everything is volatile into the future, right? So you will have changes in the markets. So like we saw in March in India, we had everywhere in the world because of COVID, stock market just tanked 25%, on just in a month's time. You will have a lot of tax changes, so which again you'll have to adjust in a dynamic manner. So I have really created this concept called the sample retirement plan, right? So when you get to age 50 or thereabouts, it's a good idea to just say that, okay, maybe whatever my actual expenditures are, I just take 5 or 10% of that money and create an investment portfolio, which I will treat as though I'm retired today. So what will happen is the next 8 to 10 years of your journey, you are really working in a very dynamic environment to adjust your portfolio, because you're just running this sample retirement plan till such time you actually retire. So now, because of those experiences, I think you will be able to very dynamically manage your money as well in retirement. So just taking this one move, just at age 50, okay, today I'm retired and I'm now shifting. They tell me where should I invest my money, and creating a retirement plan, I think is not a great idea. So I recommend the creation of a sample retirement plan, maybe at least 10 years before retirement. And so that you manage that corpus and learn yourself that how are you going to manage this money. And the reason I say that is that typically when you're doing your plans, you have the husband and wife both planning. So you have to also think about your spouse. So just think about it. So now, as per statistics, women live longer than men. So you can imagine that you may be really an expert in investing. So a good investment plan is one which your spouse can also manage. So whoever has, I would say is relatively struggling with investing, that person in the family should be able to manage your retirement plan. So you have to necessarily keep it simple and uncomplicated rather than say that, okay, I carry my investment expertise and I'll continue to manage the same way as we did, which you were doing at the current point in time. So this is a very practical way to look at investments, and maybe I'll stop here and take any questions that you have and make it more interactive so that we get a lot more insights, and whatever I know about this subject, I'll be more than happy to share with you.
Thank you, Suraj sir. So guys, if you have any question, we can either unmute ourselves and just directly ask the question, and it can be interactive that way, or we can write it in the chat box for those of us who are not comfortable in unmuting and going ahead and talking, and I'll be just moderating it from there. So any questions, please go ahead and unmute yourself and ask, or you can go ahead and type it down in the chat box. Suraj sir, the first question I have for you is around what products are we looking at which are specifically focused when we're talking about building a retirement corpus? So what instruments are we looking at?
So essentially, the only product apart from all the normal investments that you make. So there is no particular, I would say instrument that is going to be used for retirement except for one. But that again, it's up to the individual whether they want to use it or not. So you're going to first of all create a portfolio, right? So you're not going to buy just one product into it. So one product which insurance companies offer are called annuities. Right. So the role of an annuity is that you give the money to the insurance company and then they pay a pension for life. Now, the downside of an annuity is that it's not liquid and the returns are very low. The upside is that the numbers are guaranteed for life, right? So for a lot of individuals, you would be very comfortable if, like, for example, when you get your pension. So it's like generally creating this pension. And currently the annuity rates will be close to about 5.6, 5.7. So they're no different than the bank rate. But the good part is they are guaranteed for life. And so if your bank gives you a FD for, let's say, 5 years, 7 years, 10 years, annuity really guarantees you that rate for rest of your life. Now, I must also share with you that these rates are, change with the interest rate cycle. So today the interest rate cycle is low. So that's why the annuity rate is closer to 5.7%. But there are times when when interest rates go up, these annuity rates are there as high as 7, 8 as well. So some of us may be fortunate that you're retiring in a high interest rate environment. So I do believe that annuities can be one component that can be added. Second, of course, large component will be your fixed income products and equity products. Now, the only thing I must highlight here is that mutual funds, have a lot of tax efficiency built into it. So let me illustrate that with a simple example. Suppose you put 1 crore in a bank and earn about 6% interest. You will pay tax on the entire 6 lakhs. You just take it, add it to your income, and then whatever your tax slab is, you're paying a tax to it. In a mutual fund, what happens is that you will actually have to withdraw money from your account. So when you withdraw that 6 lakh rupees at the end of the year, so let's assume a similar debt fund, which also generated 6%, out of which almost 5,40,000, 5,50,000 will be your principal in the first year. So the amount liable to tax will be only 50,000 rupees. So, and this part, which happens to what are called systematic withdrawal plans, make that the most preferred choice for retirees, right? So, but obviously you must understand how debt funds work because they are not like your deposits, right? So there is this concept called mark to market. So every day their values changes, and some people find that a little tough to deal with. But I would say mutual funds would become your core component. Then, of course, you can supplement it with tax-free bonds, other kinds of bonds which are available in the market. You can buy some equity as well. So dividend income, there are good dividend-paying stocks in the stock market that can be picked for it. So I would say it is really, you have to have all kinds of products in it, and bank deposits, obviously, from a liquidity perspective, are very, very important. So I would say a good investment portfolio which has all these components is better than being skewed towards one instrument, and then you're planning your retirement around the same thing.
Thank you. If we have any other questions, please go ahead and type them on the chat box. You can also unmute yourself and go ahead.
Yes,
Or you
Suraj,
can-
I have a question for us, sir.
Yes,
Please go ahead.
yes, Saurabh.
Sir, myself, Saurabh Singla. I work in a government sector.
Yes,
So here we have an option of EPF.
yes.
So we can voluntarily also add on to that. So that corps gets created for us up to the retirement. So what are your views
Yes.
on that?
So EPF, obviously, because the returns are guaranteed, so I think currently the rates may be closer to 7.1 or thereabouts, because PPF is at that rate. So I'm assuming that EPF is there. But even if it's, let's say, a little higher than that, so obviously that's a great product. And the only thing I would also share with you is that maybe some part, if you have time on your hand, some part in equities is always good to be, because as I mentioned, that even on retirement, you don't want to be zero in equities, right? So I would say that some portion should go to the equity side as well. And whether you do through index funds or you pick up a actively managed fund, that's your choice. But some part in equities, I would surely recommend, Saurabh.
Thank you.
Suraj sir, there is this amazing buzz about National Pension Scheme, NPS.
Yes,
I want
yes.
to retire too. And
Yes.
I guess not many understand the product well because of the complexity of how it has been designed.
Yes.
आपका
So,
leading question और पूछा नहीं. That's very cheap of you. Will you tell him this? No. पूछो.
guys, can we just request everyone to mute if they're not participating? Thank you. Great. So, Suraj sir, how exactly do we position? First, the question is, should we participate in the NPS scheme? Because it extends our ATC to ATCCD. It takes 1.5 lakh rupees of tax-free income to 2 lakh rupees if we deposit 50,000
right.
a year. But
Yes.
the first question is, should one opt for that scheme? Second is, if one does, then how does one plan exits, or how does one plan? Because it's also a very illiquid instrument.
That's true. So typically what happens is that some amount has to be saved, and NPS obviously will be top of the product line from a retirement perspective for several. The reason I like NPS is one is the tax advantage you pointed out, that 50,000 rupees is exclusively available for this number. In fact, you can even adjust with the employer and ensure you get a higher tax rebate. So I think there's one more section which some companies really utilize it very, very well. Now, the catch in an NPS is, as you rightly pointed out, is liquidity. And the second catch is that when you have to annuitize it, right, at the end of that period, then about 60% can be withdrawn and 40% has to be necessarily annuitized. So my sense is that it's a great product for the simple reason that it gives you the choices where you want to invest this money. Right, so there are three different buckets in which they let you invest. They let you invest in government securities, right? They let you invest in corporate bonds, and they invest in indices. So they give you even equity choices there. So you can really create a mix basis what you are very comfortable with. So I would certainly recommend that 50,000 without fail should go into an NPS. And obviously, when you just lock in for your retirement, you are guaranteeing that, okay, come what may, I'll have a corpus, on my retirement age. So I'm a very big proponent and supporter of NPS, unless and until you really understand investing and can create a portfolio and have the discipline that, okay, I will still invest and make better returns. So NPS should be certainly a part of your consideration.
Thank you. I guess that answers Amitabh Singh's question, because he's just written on the chat box about NPS. So guys, like Suraj sir is saying, NPS is a big yes. Also because it saves around 50,000 rupees of the taxable slab. Okay. Any other questions that we might have? Okay. So when we started talking about you coming on board and the club members found out about your background, a lot of us were interested in getting to know your journey, especially at UTI and at other fund management schemes, because we create portfolios, but we've not seen that side of the journey where what exactly happens in an asset management company. So if you could just reflect of your journey in an asset management company and how complex things are, or is it a Chinese wall that we cannot see through? So just a bit about all those things.
Yeah, so see, I've been in asset management all my life, right? So I started in 1996 with Templeton, and then I worked with Fidelity for almost about 7 years, and then with UTI. And so obviously, I think asset management companies are fairly transparent. So it is not that, if you're willing to really want to understand how your money is managed in asset management companies, I think it's a fairly transparent, perhaps the most transparent, instrument that you can really look at. So let me first share with you how the investment teams are, created at, asset management companies. So essentially, we have, I would say, 3 departments in the investment side of the business. The first one is, of course, the fund managers, right? So their role is they're given specific funds to manage, and each fund is having a very clear mandate, and that mandate is also specified in terms of the benchmark. So there's also a goal set that, okay, you will beat this particular benchmark. So like large cap funds will want to beat the Nifty as an example. So if you're a large cap fund manager, you know that there are investment restrictions and you have to buy only large cap stocks. SEBI has in fact gone ahead and done a lot of product recategorization, and that itself has had a huge impact in the marketplace, right? So because now the kind of flexibility available to fund managers has been taken away quite substantially. Now, the fund manager's role is to just manage the portfolios on day-to-day basis. So they need a team which is called the research team, which really gives them the ideas that they can invest in. In fact, many fund managers actually evolve from doing research and then they get into the fund management function. So when you start your investment journey in life, you will start as a research analyst, covering a set of sectors or set of companies, and then you add more sectors to it. And then you come to a stage where you are ready to manage a portfolio. So typically what happens in a fund management company is that before you even consider buying any stock, there is what we create the investment universe. So we defines very clearly what kind of companies will we consider, if at all, for doing research, right? So these filters are like saying that, okay, you want to have companies with high return on capital, no debt. So there are many kind of filters that are created. So typically, if you look at the BSE 500, most of the mutual fund companies would have about 350, 360 companies only from those 500 companies that they think worthy of investing. They will not really invest outside of it. So within the large cap also, you will find that maybe out of the 100 stocks which are classified as large cap, 95 or 96 may be eligible. So not all 100 would be a part of that universe. So the typical day starts like this, that there is a research team and the fund management meeting every single day, where you are having look through what happened yesterday. Is there anything important that is happening? And then the fund manager will have information on what kind of flows have come in. So is it that they need to sell something out because people have asked their money back, or they have got surpluses, and so they have to now take a decision, which are the ones which they would like to buy or sell. So typically the research analyst would be preparing a chart and telling the fund manager that this stock at that price, according to the research analyst, is it a buy or a strong buy, or a sell or a strong sell? So all the portfolios that you have, all the stocks, you are very clear that at that price, whether you should be buying it or you should be selling it. And then there is the trading and settlement team. So once the order is created, right, by the fund manager saying that I would like to buy this, the execution of the order is done by the trading and settlements team. So they really execute it, and then they go and buy and place the order with the broker, and the deal gets executed. So I would say it's a very structured way of living, because ultimately the fund managers or the analyst's role is only to spend all the time looking at the underlying companies and hopefully demonstrate their expertise by delivering superior performances in funds. So that's how the fund management industry works. So the team sizes typically would be, let's say, 10 to 12 people in research, 4 to 5 fund managers, and 3 to 4 people on the dealing desk. So that's typical fund management structure in India. Global fund managers who run global portfolios may have even 600, 700 people in the investment side of the business, because globally you have about 7,500 companies that you can really invest in. India has an investable universe of about 350 companies which mutual funds can invest in. So the most diversified fund, if you want to find out, is the Vanguard, global stock fund, which has underlying holdings of close to, if I remember right, 7,000 companies in it.
Great. Thank you, Suraj sir, for that question's answer. Also, there was a lot of buzz when we were, inviting you because lately UTI got listed, AMC got listed, and you're the president for the group for quite some time now.
Yes.
So I would not, directly ask you whether it's a buy or a strong buy or a hold or a strong hold. But overall, we already have seen amazing returns on HDFC AMC, and it has really helped, in retail investors. It's a go-to stock when we're talking about financial services space.
That's right.
Also, because there are only so many businesses in terms of AMCs that are listed, and we are looking at the GDP contribution of AMCs keep growing day on day or month on month.
That's right.
So the idea is, are we how bullish are we on UTI asset management company in terms of a normal investor, not like a president of the ex-president of the group, but if I would ask, if you have surplus today, would it be in your portfolio?
Yeah, so okay, let me first start with a disclaimer here that I don't own any UTI shares, and nor did I apply to the IPO, not because I don't like UTI, but because as an individual I have this rule that I don't buy IPOs, right? Because I want price discovery to happen, and then I really start looking at investing in any stock that I consider. So first, let me give you the sectoral view. So basically, there are three companies now with UTI getting listed. So you have HDFC, you have Reliance, which is Nippon Life, which has happened, and third is UTI. Now, if you look at it, each of these firms has a unique set of strengths and weaknesses, but before that is the industry dynamic that has to be understood. So what has happened is, about a couple of years back, the regulator brought in a law saying that as the fund scheme size goes up, right, you will earn less and less amount of fees, right? So obviously, what it means is that if, let's say, the AUM of UTI grows from 1,50,000 in mutual funds to 3 lakh, what they make on 1,50,000 is much higher in terms of margin as compared to what they'll make on the next 1,50,000. And this is true for Reliance. This is true for HDFC as well. So I do believe that the margins are going down because of that reason. Second is there is a very strong, move towards passive products. So because active fund managers charge higher amount of fees, passives are very, very cheap. So just to give you some numbers, a typical index fund, which is listed on the exchange, ETFs, you earn only 8 basis points, 0.08%. But in an active fund, you actually charge 1.4%. So the margins are really different. And there's a big shift which is happening towards that as well. So this again points out that as the industry assets grow, the revenues will not grow in the same line. So as a result, if you're not going to grow at that same pace as what you see the growth in AUM, then obviously you have to start predicting that what kind of revenue growth will these companies deliver. And as I pointed out, the revenue growth is also linked to what happens in the marketplace. So at lower rates of interest, which are currently prevalent, your equity returns are also lower. So the core growth that you're seeing is anywhere between, let's say, 8 to 10% in assets, right? So the revenues of these companies hence may grow only at 5 to 6, right? So unless inflation comes in and then the nominal, rates change dramatically. So my view is, because of this reason, the valuation becomes fairly important. And currently the multiples, I think, which are being given to HDFC or Reliance or what UTI may also get, I feel is on the higher side, right? So to that extent, at a particular price, asset management is a great business because you don't have to send bills to anyone. Every day your account gets credited. So when we compute the NAV, straight away the money comes in. So it's a great business to be in. But I would say a good time to buy is when there's little stress in the market, because you will see that asset management companies' prices come down very sharply, because they're so linked to the market, completely linked to the market, by the way. So I think if you see weakness in the market, you may get these companies at far attractive valuation than what they are currently trading. All the three, by the way. And But yeah, you must have it as a part of your long-term portfolio once you enter at the right price. And then you need not ever sell it, because it's such a growing business over the next 20, 30 years. I think asset management will be very large in the country.
Thank you, sir. Also, there is a question in the chat box. Members would like to know, there is a growing number of international funds that are being
Yes.
offered to Indian investors,
Yes.
including both passive and active funds.
Yes.
So, if need be, we all know India as a growth story is doing great, and probably will keep doing great at least for another decade or so.
Sure.
So, should we be looking at diversifying to international assets, or is it still a fantasy that I own X number of apples, or I know X number of Alphabet shares? So, is it still the fantasy where we want to invest globally? Should we be considering that, or does it practically make sense to diversify or to bet off Indian economy as well?
So first of all, let me share with you that all your expenditures that you make in India, right, are also linked to the dollar, right? So the Apple phone that you buy, right, the fees that you pay. So if you have children which are going to international schools, right, so they will have this, royalty to be paid to IGSC, which is again in dollars. All Indians love to travel abroad, right? So there is always expenditure on dollars when you travel abroad. So if certain percentage of your expenses are anyway in dollars, right? So why would you not be investing outside of India? Now the question is, what should that proportion be, right, in international funds? So like I have a daughter, she studies at California, right? And today my largest expenditure, by the way, is her fees, right? Because US education is not cheap. So for an individual like me who's going to have such a large expenditure in dollars, then obviously I need far greater proportion in international funds, because I would eventually hedge myself against the dollar by buying those products. So I would say it is linked to your needs. So minimum 15-20% in international funds, I think, is always a good idea. And I must also share with you that if you break down the world market capitalization, right, so which is the value of all the companies listed in the world in dollar terms, India is just 4% of the world in terms of market capitalization, and US is 51%. Right. So I not only recommend you buy international, but I recommend that it has to be US to begin with, because that's the largest market. Then of course it's your own personal, comfort with whether you buy the index or you buy something active or you buy specific stocks. So those risks are, like any other market. So you will have challenges also in terms of the exchange rate. So you have to keep all those things in mind. But yeah, it's a no-brainer to buy into international funds for sure. But don't buy because they did well last 5 years. I think that's the wrong reason to buy. So many people buy because it's done well the last 5 years.
Great. Yeah. Thank you, sir. One last question that we have this evening is, how do we exactly choose amidst all these varied asset classes, or, within an asset class, how do we exactly choose of this AMC, this fund, this manager? And also an additional question to that is, or the follow-on question is, when a fund manager moves to a different fund or to a different AMC, we've seen that there is a trend that investor base or the anchor base also moves with him. So should we also be trying to copy that, or flow with the outflow and inflow depending on the fund manager's exit and entry first? And also, should we be thinking about a fund? Should we be looking at the underlying assets and then valuating it? Should we be going that deep, or should we simply be looking at the goodwill of the AMC and goodwill of a fund and then just investing in it?
So the good news for you is that SEBI has actually done your job simpler, by creating what are called these product categorization guidelines, right? So just to give an example, so guidelines on equities says that if you are a large cap fund, then you have to invest 80% of your money in companies with market capitalization from 1 to 100 in the country, right? So now if that is the case, what will happen is, if you buy a large cap fund and a mid cap fund, for example, as two examples, you will see that the underlying overlap is not there, because the universe has been defined by the regulator very distinctly. So I feel that when you create an equity portfolio, you must have one large cap, one mid cap, maybe one or two small cap, because small cap has a long list that you can invest into. So you can even look at 2 small cap funds. And within that, now you can start saying that, do I want the active or the passive? So for example, if you're buying a large cap fund, you can buy into a large cap active fund, or just buy the Nifty 50 and Nifty Next 50. So you'll get the same ratio of the top 100 companies. And so my view has always been that when I start, I would buy one active, one passive in each category. And if my active managers don't beat passive, then I'll stay passive for my life, because why would I pay an additional fee if I'm not getting, the desired results out of it? So, but you have to be patient. You should evaluate this over a 3 to 5 year investment performance, not really, just because 1 year somebody's underperformed. That's not the way to really look at it. So I would say that if you buy one large cap, one mid cap, one small cap, one international, you have a very beautiful and diversified portfolio. The problem is that today, when I look at portfolios, they're all large cap portfolios, because mid and small is not doing well. So people don't have it. So people don't practice diversification, they talk diversification. Yeah.
And Suraj sir, how do we address the stigma or the stickiness Indian masses have for a portfolio manager? Is that okay to have, or is that not a good notion?
Well, I would always say that till the performance is there, you should stick. Don't be blind and just stick to a fund manager. I don't think so. That's a good idea. That hurts you eventually. So
great. And Karan has just put in a chat box. He's asking if you're a starters, if you've just started, direct equity versus mutual fund, what would you recommend? I think it completely depends on how well you understand which product. But Suraj sir, over to you. Direct equities or mutual funds?
No, so I'm very clear. It has to be mutual funds, because by definition, when you buy a direct equity, leave the expertise part. But expertise in markets is to say that I know that even with the best of research, I can go wrong. So hence, I must diversify. And typically, when you're starting with small amounts. You're not putting very large amounts. So you should do direct equity only after you have created a reasonable size of corpus, right? So that the effort that you do in research gives you some decent results. So for example, in my career, of course, I started with equities because those days everybody would buy into IPOs. And then I realized that why am I doing all this effort of finding direct equities? Because if I do the same effort in my own job and do well for myself, I'll hopefully get better increments and let the fund managers worry about what's happening. But as the corpus got created, now there was merit in me investing my time, because I would get a great bang for my buck. So if you just, let's say, invest a lakh of rupees and you double your returns, you still make 100,000 rupees in absolute terms. Maybe your work can deliver much better results than that 100,000 that you earn. But once your corpus is 3-4 crores, then maybe direct equity makes sense. So I really find it a little bit surprising with the kind. So in fact, in India, many of us start with options and futures. We don't even start with direct long-term equity cash buys. We start straight by saying, let's punt and see what happens. So, but my vote is clearly for mutual fund. I don't think so. I have any doubt in my mind about that.
Thank you so much, Suraj sir. And we'll be sharing your email address with the members of the club, so that if they have any follow-on questions or doubts, they can directly email it to you.
Sure.
Thank you so much for your time, and may you have a lovely weekend.
My pleasure.
Ahead. Thank you so much. So guys, it was Mr. Suraj Kaeley, the ex-president, group president for UTI Mutual Fund, and he's also a strategist at retirement planning. Thank you so much for your time, everyone. Thank you, Suraj sir.
Thank you, man.